Starting to invest in ETFs, exchange-traded funds, is an excellent way to build a diversified portfolio with lower costs and greater flexibility. I'll break down the process into a few essential steps and list some important considerations so that your first purchases are solid and strategic. 1. Understand what an ETF is and how it works. ETFs are funds traded on the stock exchange, allowing you to buy a basket of assets like stocks, bonds, commodities, or a mix of them, all at once. Each ETF has a specific goal, such as tracking an index, e.g. S&P 500, following a sector, technology, healthcare, etc., or focusing on a strategy, dividend ETFs, ESG, etc. Before buying an ETF, it's crucial to understand its composition, its benchmark index, and how it aligns with your investment goals. 2. Define your goals and risk tolerance. Think about your objectives. Are you investing for retirement? Building wealth for a long-term project? Each goal may require different ETFs. Know your risk tolerance. Stock ETFs, for example, tend to be more volatile, while bond ETFs are usually more stable. Understanding your comfort with market swings will help you choose ETFs suited to your profile. 3. Choose an investment account type and platform. In the US, the most common brokerage accounts are standard brokerage accounts, IRAs, individual retirement accounts, and 401k accounts. If your focus is long-term with tax advantages, an IRA may be worthwhile. Check with your brokerage for the ETFs available in different account types. Select a platform that offers an intuitive interface, low trading fees, and access to a variety of ETFs. 4. Study the ETF's expense ratio. Every ETF has an expense ratio, which covers operational costs. This fee is expressed as a percentage of the invested amount and is charged annually. Prefer ETFs with low expense ratios, as high fees can impact long-term returns. ETFs that track market indices, like the S&P 500, generally have lower fees, while actively managed or specialized ETFs tend to charge a bit more. 5. Consider diversification. One of the great advantages of ETFs is instant diversification. Instead of investing in a single stock or bond, you're investing in a basket of assets. To start, a mix of stock and bond ETFs can offer a good balance of risk and return. Over time, you can expand to specific sectors like technology or healthcare, or invest in international markets. 6. Pay attention to volume and liquidity. Check the trading volume and liquidity of the ETF. ETFs with high daily volume generally have smaller spreads between the bid and ask prices, making transactions more efficient. Avoid ETFs with very low volumes, as they may be harder to sell quickly without affecting the price. 7. Review historical performance and volatility. Analyze the ETF's past performance and volatility. While past performance doesn't guarantee future results, it can give you an idea of how the ETF reacts under different market conditions. ETFs that track large market indices tend to be less volatile, while thematic or sector-focused ETFs may experience larger swings. 8. Regularly monitor your portfolio. Keep track of your investments to ensure they remain aligned with your goals and risk tolerance. Periodically rebalance your portfolio, especially if the value of a particular ETF grows significantly and becomes a large part of your portfolio. Important considerations. Don't chase trends. Thematic ETFs, such as those focused on artificial intelligence or clean energy, may seem attractive, but it's essential to ensure they make sense within your long-term strategy. Pay attention to tax implications. In the US, capital gains from ETFs are taxed, and rates vary depending on whether the investment is short or long-term. Long-term strategies, such as holding investments for more than a year, generally have tax advantages. Avoid overdiversification. Investing in too many ETFs at once can reduce the positive impact of diversification and make the portfolio more complex to manage. Conclusion: investing in ETFs effectively involves research and patience. By following these steps and paying attention to these considerations, you will be building a solid foundation to achieve your financial goals strategically and intelligently.